Have you ever felt like a stranger looking at your own retirement account? You see words like volatility, market correction, and growth stocks, and suddenly you feel like you are reading a foreign language. It is not because you are not smart enough to understand money. It is because the financial industry has spent decades building a wall of jargon designed to make you feel confused. They want you to feel helpless so that you will hand over your life savings to a so-called expert who charges you a fee to explain things that should have been simple from the start. In the next 10 minutes, I am going to tear down that wall. I am going to show you why most of the terms you hear on the news are nothing more than smokescreens designed to take your money. By the time we are done, you will never look at a financial report the same way again. Welcome to the truth about the stock market that they do not want you to know. Let us start with the biggest trap of all, the way they use language to control your emotions. Think about the word volatility. The experts use this word constantly when the market starts to drop. They say, we are seeing some increased volatility in the markets today. But what does that actually mean for you? In plain English, it means the value of your hard-earned savings is swinging up and down like a roller coaster. They use a technical term like volatility because it sounds scientific and unavoidable. It makes it seem like a natural weather pattern that no one can control. But for a person who is 60 years old and planning to retire next year, volatility is not just a math equation. It is the fear that you might not be able to afford the house you wanted or the trip you planned for your grandkids. When they say volatility, they want you to stay calm so you do not move your money. But when they say market correction, they are doing something even more devious. A correction sounds like something good, does it not? If you make a mistake on a test, you want a correction. If your vision is blurry, you get corrective lenses. But in the stock market, a correction means your portfolio just lost 10% of its value. Why do they not just call it a 10% loss? Because loss sounds painful. Loss makes people want to pull their money out. So they use the word correction to make it sound like the market is just fixing itself. They want you to believe that losing 10% of your net worth is a healthy and normal part of the process. It is a psychological trick to keep you invested while the big players on Wall Street decide their next move. Now, let us talk about the growth stocks trap. If you listen to the young analysts on television, they are always talking about the next big growth stock. They tell you that you need to be in these high-flying tech companies if you want to build real wealth. But here's the truth they hide in the fine print. Many of these so-called growth stocks have never made a single penny in actual profit. They are growing their user base, but they are losing money every single day. For a 25-year-old, a growth stock might be a fine gamble because they have 40 years to recover if the company goes bankrupt. But for you, growth without profit is just a high-stakes bet with your retirement fund. Wall Street loves growth stocks because they create excitement and high trading volume, which leads to more commissions for them. They do not care if the bubble bursts 10 years from now, but you certainly do. Then there is the concept of a bull market versus a bear market. They tell you that a bull market is a time of great prosperity and that everyone is getting rich. But a bull market is often when the most dangerous bubbles are formed. It is the time when prices are pushed far beyond the actual value of the companies. When the market is charging ahead like a bull, that is exactly when the professionals are starting to look for the exit. They wait for you to get excited and put your last bit of cash into the market at the very top. And then, when the bear market arrives and prices start to fall, they use that same fear we talked about earlier to get you to sell at the bottom. It is a cycle designed to transfer wealth from the patient and the confused to the people who write the dictionaries. Now, let us look at the most dangerous term of all, the quiet killer of your retirement. I am talking about the expense ratio. It sounds so small and insignificant, does it not? A 1% expense ratio. It is just 1 penny for every dollar. What is the big deal? Well, here is the secret that the S&P 500 index funds and active managers do not want you to calculate. If you have a portfolio that grows at 7% per year, but you are paying a 1% fee to a manager, you are not just losing 1% of your money. you are losing nearly 15% of your annual gains. When you compound that over 20 or 30 years, that tiny 1% fee can eat up more than 1/3 of your entire nest egg. Imagine working for 40 years, saving every penny, and then realizing that a guy in a suit took 30% of your final balance just for moving some numbers around on a screen. The SEC has published data showing exactly this, but you will rarely hear it mentioned in a sales pitch for a mutual fund. They call it active management to make it sound like they are working hard for you. They want you to believe that they are smarter than the market and can pick the winners. But the data from the S&P Dow Jones indices is clear. Over a 15-year period, more than 92% of professional fund managers failed to beat the simple, low-cost index. You are paying a premium price for a subpar result. It is like paying for a gourmet chef and getting a cold burger from a drive-thru. So, how do you protect yourself from this language game? You start by simplifying everything. You stop looking at the 100 terms they want you to memorize, and you focus on only 3 things that actually matter for your security. The first is dividend yield. Think of dividends as your true retirement salary. A dividend is actual cash that a company pays you just for owning their stock. It is not a guess. It is not a projection. It is money in your bank account. While the rest of the world is obsessing over volatility and growth, you should be looking for stable, boring companies that have paid dividends for 50 years straight. The second thing to watch is your actual asset allocation. Forget the fancy models. Do you have enough cash and bonds to survive a 3-year downturn without having to sell your stocks? If the answer is yes, then you have won the game of volatility. The market can swing all it wants, but it cannot force you to sell if you have a safety net. The third thing is the net profit margin. Ignore the growth hype. Look for companies that actually keep a large percentage of every dollar they make. A company with a high profit margin is a company that can survive a recession and keep paying those dividends you rely on. The financial world wants you to believe that investing is a complex science that requires a high-priced guide. They use big words to make you feel small. But the truth is that the most successful investors are the ones who refuse to play the jargon game. They know that $1 million today is not just a number on a screen. It is your freedom. It is the ability to say no to a job you hate. It is the peace of mind knowing that you will not be a burden to your children. It is the legacy you leave behind for the people you love. Do not let them steal that from you with a few fancy words and a 1% fee. When you see a news report talking about quantitative easing or fiscal hawks, just remember what they are really talking about. They are talking about your money and your future. You have worked too hard and waited too long to let a smokescreen get in your way. The next time a broker tries to sell you on a complex strategy with a name you cannot pronounce, ask them one simple question. How much of my profit are you taking, and what is the dividend? If they cannot answer that in plain English, walk away. Real wealth is built on simple truths, not complex lies. You have the power to take control of your financial destiny right now. It starts by demanding honesty and choosing simplicity over the hype. Thank you for listening to The Truth today. Stay disciplined, stay skeptical, and keep your focus on what really matters. I will see you in the next briefing.